So we're not seeing a lack of intent, but we are seeing a lack of action. So that comes to today's discussion, and I am absolutely delighted to have a wide representative on my panel from UK Bank, International Bank, consultants, and asset managers. So it's fantastic to have you all here. So I am joined by Carolyn Horn, who's the Vice President of Sustainable Solutions Group at ING, Stephen Jones, Global Chief Investment Officer at Aegon Asset Management, Sophie de Jonker, Director, Head of Climate and Sustainability Strategy at Lloyds Banking Group, and finally Julie Malzak, Director of Finance and Sustainability from Accuracy. So I would like to start the panel session with what does it actually look like in practice today? What are we seeing? So Carolyn, I'm going to start with you. ING operates globally across sectors and markets. Where are you actually seeing the transition gaining traction, and where are we fundamentally stuck? Oh, Stephen will have to share his mic with you.
So nice to be here, first of all. So maybe for context, ING operates within 36 countries across EMEA, APAC, and Americas. So you could imagine that the transition looks very different in all of these locations, and so there are challenges, but also kind of opportunities that are also very geographically local. So what I'm going to say now is more like the overlay of what I have heard also and experienced across these locations. I think one very important point is like a policy environment that is enabling growth and change and transition that is really popping up left, right and centre where we are. Another point that really helps scaling it is the when like the cost curve kind of tips and the economics start really making sense without the subsidies. So that is when we see all the commercial banks really jumping on the opportunities and really also wanting to finance that. And another point, and that's also what Claire had mentioned earlier, is like when there are co-benefits. So it's not only the transition, but it's also like costs that are being saved. Then there are elements around energy security that I kind of like play all into this kind of environment. So I feel like the renewable transition element is the most prevalent one and probably the most successful one that we've seen across the globe. So also like just kind of reflecting also what Claire said, it's kind of like the growth that we're experiencing currently, but also looking forward, it's kind of in the 2-digit % annually. So I feel like that is a really success story. Major challenges is where like whole value chains have to move together. And also there are like these very massive upfront costs. So what I'm thinking of instantly is the shipping industry. We're engaging with a lot of ship owners where we see they're really willing to kind of transition, but they're playing together with their charterers, with port owners across the globe, and all of them have to move in the exact same direction to make a transition happen. So I feel like this is where we're kind of a bit stuck in kind of this chicken and egg problem of like, okay, who should move first and in which direction are we going?
Thank you. I have a spare mic here, so Stephen isn't left out. That's really interesting because you talked a little bit about the localization of some of the investments. So if we come to a UK bank, Sophie, from Lloyd's position at the centre of the UK economy, does the transition actually show up day to day in your lending portfolio conversations? So what does it look like in practice?
Yes, absolutely.
Is it on?
Yeah, I think I have three quick headline points that I'll summarize and then go into a little bit of detail. Number one, the transition is tangible in the UK. It's absolutely happening. It has irreversible momentum, which is great. It is not enough, but it is there, and it's happening in spite of political headwinds. So that is good to see. Point number two is that the drivers and challenges do indeed vary very much by sector, and they are very localized. So I'll give a few examples in a moment. And then the final point that I think we've been talking about a lot is clients are talking a lot less about environmental impact in conversations with us. They're talking a lot more about value generation. Those are not necessarily different things, but the way they're framed is different these days. So on the first point, in a world where emissions they still haven't peaked, emissions in the UK are down 2%. Win-win-win.
Well, that's a positive for
It's a positive. It's not enough, but it is a positive. They're down 54% since 1990. right? So that's compared to an EU average of about 36%. So we're doing quite well. We've phased out coal, we've invested at record levels in renewable energy. So that is all great, very driven and guided by the UK government's Clean Power 2030 plan. We're seeing this transformation at client level. 93% of our biggest corporate clients have set long-term decarbonization targets. That's not necessarily a shock. 45% of them have plans that are science-aligned across all three scopes. So we're not counting ones that only have scope 1 or scope 2. All three scopes, 45%. And then where it gets interesting is that 60% of those biggest clients actually have detailed costed allocation plans in support of those targets. So that is good news. It sounds great. Again, I think if we're going to reach Paris, we have to be reducing emissions by 8 to 10%, not 2. So, there's still work to be done. How does it show up in sectors and in locations? So, for example, domestic transport makes up 31% of the UK's emissions. Emissions have increased 2% in that sector, where they went down in every other sector in 2024 to 2025. The good news is that EVs are approaching price parity in the UK. So that's very positive. But our clients in conversations with us have told us that especially the auto manufacturing clients, they're struggling with lower consumer demand for EVs than they expected. Some of them are explaining that they have EVs sitting in storage costing them money. Right? And this is potentially due to high energy prices. I don't want to charge a car with sky-high energy prices, electricity prices, delayed UK phase-out for conventional fuels, or even range anxiety. We did do a study on this, and did you know that 97% of UK motor service stations have EV chargers? Fun fact.
That's an exciting fact.
It is an exciting fact. I have so many more examples, but I'll just jump to the final point. I think what I said before, it's all about value generation. Now when we talk to our clients, they all remain committed to their sustainability targets, but not necessarily to the labels or the reporting platforms. So a lot of our conversations are about how they can continue to finance the work that will support decarbonization, but how can they do so in a way that streamlines their reporting platforms and reduces their costs, focusing only on those initiatives that are most material to their business model, which I do find encouraging, because we can now trust that when a company says they're doing something, it's not just greenwashed fluff.
It's nice to have some optimism on this on the stage today. So I'm going to move on to asset management. So Stephen, from an asset allocation lens at Aegon, how are you currently characterising the transition, and where are you actually deploying capital today that reflects this in practice?
We have been on a journey in that 2019, Aegon overall decided to allocate a specific nominal amount of its balance sheet towards investment in climate-themed assets. Over that time, that was $2.5 billion by 2020. And we did that gradually, always seeking an economic return, and actually finding quite a good range of assets through commercial mortgage-backed house building and homes to invest in, information technology solutions, efficient data center build. Data centers get written up very badly as energy-intensive, water egregious type awful assets, but we are going to need them, and there is a way to build them and invest in them with circular water cooling and efficient building design and in the right place. And if you seek out those assets, you can invest in them and underwrite them. And similarly, quite a lot of solar comes in and renewable energy. And we added to that $2.5 billion with another $1 billion in 2024 with an idea that we would complete the program in 2029. As of now, we've nearly completed that program, so 3 years ahead of time. So there's plenty of good opportunity to underwrite and invest. And I think that story of labelling and then a broader range of assets emerging that maybe don't have labels but have credible plans is exactly the journey we are on now. If we look at it in public markets, when we started thinking about climate transition investing, specifically in fixed income, then there were maybe 500 companies globally that had science-based, backed, validated plans for carbon management and, in most cases, some sort of net zero sort of goal at the end of it. As of today, there are 3,600 of those opportunities to invest in. Not all of them, in fact, actually very few, as the stock exchange presentation showed, would necessarily go down a labelled route. But the debt that they issue or secure from both public and private markets is part of the overall corporate plan that's embedded to manage to a transition, both from the point of view of environmental impact, stakeholder credibility, and also efficiency and cost saving. So I'm generally optimistic that whilst we might be behind and we are potentially tackling some of the easier things first, that the momentum in providing solutions, finance solutions to the climate transition is really quite real. And to back that up, I think there's a recent report from HSBC that says, you know, in their metrics and definitions that climate finance and transition financing has grown 20% a year over the last 10 years. You know, is now totaling over 2 trillion. And looks set to continue that way. And that's needed, but the momentum is there to fulfill that sort of ongoing projection and need.
Thank you. We've now heard from some financial professionals. I'm coming on the consultancy side. Julie, it's lovely to have you with us. From an advisory perspective at Accuracy, what are you seeing from your clients?
So exactly what we see from our clients from the financial point of view, financial advisor, is that, as a good segue from the data part, our clients are mostly corporate clients and they're asking themselves the big question on the figures. So transition has really entered the CFO agenda. They want to know what is going to be the impact on their cash flow, what will be carbon cost in 10 years from now, will their assets be stranded or not? And all those questions we feel come from 3 main drivers. The first one, and it will come at no surprise from a French person, is regulation. We love regulation. And so in the European Union, there are several of them that have real cost impacts, and I'm thinking of EU ETS, carbon border adjustment mechanism. Those 2, for instance, have real cash flow impact, have entered really the financials, and so those have impacts to our clients. That's the first topic. The second, I'd say, they come with us, and the driver are really question on capital allocation. Where should they go? What should be the priority? Should it be, I don't know, decarbonization? Should it be electrification? Should it be the supply chain? So they need to have metrics and to decide on where to allocate their money. And the last topic is on financing, because of course they need to raise money, to invest, and if you don't have financing, of course there's nothing you can do. And when all of that comes along, and when our clients have asked themselves and received some good answers to all of those 3 points, they can move, and that's what we've seen, for instance, recently in Dunkirk with ArcelorMittal, where they've invested more than 1.3 billion euro towards decarbonization for their furnace. And of course it comes because there's a regulation, because they've have some certainty on the pricing, some security on the financing. So to come back to your initial question, what we see is really that transition has moved from a reporting topic to a financial one.
I think it's so positive to hear from all of you that actually we are seeing money being deployed. I think the question we have, you know, Claire touched on this, is it's clearly not enough at the moment, and we need to see some sort of acceleration. So my second question was going to be, why is delivery proving so difficult? I'm going to amend that after these answers, because it's clearly happening, but just not at the scale that we want it to. So Julie, if I stay with you, You work directly with the leadership teams under pressure to decarbonise. You talked about these three things that they're looking for. What are you seeing as the biggest tension within your client base to accelerate this transition?
So what we see from our clients, they are always asking the question of competitiveness. Will the investment make me competitive? Is there a tension between sustainability and profitability? How to address this topic? So the real tension, I feel, is here, and in theory, it's not really a tension between sustainability and profitability, because they know that they have to decarbonize, they know that they have to invest in energy efficiency. But what we see is more on the timing. There's a timing issue between the long-term value creation and short-term financial constraints. And it's what we see is a J-curve, where you have to invest first, and of course at the beginning your return on investment may not be that good, and you will gain the profitability a bit later. And the trouble is that some CFOs are only looking at a 5-year period, which is not enough to gain all the return on your investments. And to this point, to illustrate those tensions, we can think of several examples, but one of Ørsted, for instance, that really shifted from a business model where they were fossil fuel based, and they shifted to a renewable model, which of course is a successful and a success story and a good way to have a sustainable model. But then 2 years ago, they were facing real difficulties and financial constraints once again, and I think it's illustrates also the fact that even if you have shifted, navigating this J-curve can be really difficult, and that's, just to conclude, I think that transition gives you the ambition, you know where you're supposed to go, but then of course it's entering into the financials that will help you navigate the tough investments.
Thank you, Julia. I think that takes us neatly onto the asset manager who's actually investing in these companies. Clearly, it needs to be driven from the top. You need to have CEOs who want to do this, and as we know, CEOs don't always stay around a long time. So, from your standpoint, do you think there's a timing issue? What is still preventing capital from flowing at scale into some of these transition-aligned opportunities?
I think the attitude of companies overall, part of that 3,600 with credible climate validated transition plans has gone beyond the sort of personality of CEO or other leadership groups into this is how we do business around here. And I think that is something that has gathered momentum over the last couple of years, and I think we can be reasonably confident isn't going to fall away.
It's a cultural shift.
There's both from a stakeholder, a stewardship point of view. This is no longer the side topic, it's very front and centre. You're not credible unless you have robust plans, and I think stewardship and engagement has worked in this type environment. And indeed, we saw it quite graphically illustrated in the recent sort of voting activity around BP, say, where there was a very clear owner stewardship response to attempts to not report as thoroughly on this or to water down some of the issues that are fairly mainstream. They weren't about BP's ultimate struggle being an oil company trying to be renewable, but they were about information and sensible sort of disclosure and shareholder rights around that. So I think we can be reasonably comfortable that this is not a fad. The issue about mobilising capital here and now, I think, is a bit more around fragmentation, to be honest. Some of the big mobilisation of capital around renewable energy, I'm thinking about offshore wind at scale, thinking about the grid transmission mechanisms, have been attractive because they offer scale and were able to crowd in both domestic and overseas capital to them. And those are relatively easy and mainstream to fund. I think it becomes a lot more difficult to find projects in a sort of mid-scale sort of environment where they would have impact and meaning, but are just not big enough to merit the amount of due diligence and underwriting and sponsorship that is part of being a credible lender to this this particular theme and need. I've seen something recently where you look at something that's sponsoring 24 rapid chargers in a regional area. What you need is a super regional area charging network or a national charging network, God forbid, so that we could actually have consistency and scale both in the implementation to get the unit cost down and also the commonality of use, and it's very important we take people with us on this whole transition and utility journey, and also offer a diversified revenue base across a multi-regional type exposure for those that are going to fund it and provide the capital. So I think that is where I think some of the difficulty is now in the middle ground.
Again, coming back to localised rather than nationalised or localised. Carolyn, are you seeing that as a banking institution financing? What are the biggest constraints when you're thinking about the scaling up that Stephen's just said we need?
Yes, that's an interesting one because I'm looking more from a lending perspective than on a deal-by-deal basis. So what we see is that we see more volumes coming our way that have like circular business models, sustainable fuels, but also like other low-carbon type of technologies that like want to get financings from a commercial bank, but I think it also comes back a bit to like what a commercial bank can and cannot do. In the end, we are here to price the risk, and when the risk is too high, it's very, very difficult for us then to provide capital. What we see as major barriers, and also kind of saying a bit like the not so positive sides here, is also the elements around like, well, where do the revenues come from? What are the operational risks of these assets? How can we like see the technologies throughout the financing? So these are all considerations that we have to take into account, which we also see like somewhat limiting at some points these scalabilities, because these technologies might not be as proven. They take a longer time to assess. You will have to like set people apart in your bank and say, okay, you are going to work on this, and this might not be profitable, as opposed to work on something which we know is profitable. So I feel like a lot of elements come together from like a strategic banking perspective to a very like deal-by-deal assessment perspective. To really scale and really like let lots of capital flow, because it will be smaller financings, it will be smaller solutions that are also needed.
Thank you. Sophie, from a UK real economy perspective, what do you see as the single biggest blocker to the scaling up?
I had trouble with this one because I think, as we've discussed already, it varies so much per sector. And can be very place-based and even technology-based. I think, zooming out from the UK context for a second, one observation I would have is that unreliable policy direction is often the biggest blocker for system-wide investment. Right? We've seen that in Australia. We've seen that in the US when the direction flips 180 and could flip again. With a change of administration, I think the private sector is stuck in a hard position. It's hard to invest for the long term when that's not reliable. So coming back to the UK economy, again, I think I wish there was a silver bullet. I'm not convinced it's always finance. I think finance can be a blocker for first-of-a-kind technologies that we do need to scale and get off the ground. Just yesterday, we convened stakeholders from policy, from government, and from project developers to talk about what could be the art of the possible here in Scotland to support the energy transition. It was very inspiring. We heard about microgrids that could create revenue streams for councils. We heard about SMRs that were community-owned that could deliver 4,000 jobs. This was very inspiring stuff. I took notes on the barriers precisely for this question. And they were citing things like permitting and licensing times, right? It's not financial, that's administrative. High energy prices, lack of reliable off-takers at scale, also lack of clean fuel at scale. That was a nice connection that we were able to make on the spot. And then yes, access to finance, or lack of access to finance with high risk appetite, or with gumption, as it was described. And so instead of pointing to any of those single blockers, I think that I would zoom out. A key consideration I keep coming back to is that if we're hoping for a real economy transition, it's not just an energy transition, it's an integrated systems transition, and so we cannot afford to ignore nature integration, social integration, and climate adaptation. If you're a business, this is a commercial imperative, if you're a business and you have depleted your natural resources, your inputs, or you've lost your social license to operate, or your assets are constantly underwater and no one will insure you, you're out of business. And so a transition needs to consider all of those things altogether.
I think that brings a very valid point, that we're sort of slightly missing the social enterprise and the small-scale companies, because this is not necessarily in your space at all, but actually they're the ones who need to be able to scale up so that they can come into mainstream capital. Now, I just have to warn my panelists, because we're sitting here looking at the clock. It says we have 17 minutes. I can guarantee you we do not. The clock starts 10 minutes later. And me as a good chair of this panel, it's going to make sure we don't overrun. So we have literally 5 minutes left to wrap up. Before, I wasn't going to take questions because we had 4 people, but what I'm going to do is I'm going to ask each of my panelists one final question. If we have time, I will open it up to a question. If not, I'm going to be very good, Sarah, and hand straight back to you. See, but she's already turning me off. So I also wanted to make sure that Sarah knew I wasn't going to overrun. One final question for the 4 of you, and if you do have questions, these lovely people will be around later, you can corner them. If there was one thing that you would like to see changed in everything that we've discussed today to help accelerate that transition, what would it be? And I'm going to start with you and come all the way down. So Karen first.
That might not be a very banker-friendly answer, but I feel like sometimes in the conversations I have with a lot of companies, it's like it comes across as the transition is a burden, where I feel like it's an opportunity. So what I feel like is missing is this curiosity piece, this kind of like, we want to develop, we want to change, and it's going to be better. I feel like this attitude of like, we can do it and we want to do it, I feel like that is something that sometimes is really missing.
It's definitely not a banking philosophy. Being curious, I love it. So Stephen.
I think I would try and reset some of the risk appetite around these activities. We are faced with a situation where I think there is quite a lot of money mobilising for transition investments, private infrastructure investments, resilience initiatives and assets. And that comes from defined contribution pension schemes as they mobilise into mansion house accords and put private assets into those pools of capital and do it with a UK-type flavour around it. It comes from local government pension pools, which are in very significant surpluses relative to their liabilities as part of their Fit for the Future enhanced pooling arrangements. And it comes from private capital generally seeking returns that are attractive and robust. But all of those, I think, come with, ooh, that's a bit risky. There's a sort of mindset. And I would try to reset, at least in small part, for certain elements of that capital stack that's available, the risk appetite, because, we touched on it just here, but the initial seed, the venture seed, is quite difficult to find. And it does require a slightly different attitude. And one that we as stakeholders in those bodies that look after our money are also prepared to see fail. It's not going to be the latest crisis. It's not going to be the XYZ Guardian Chronicle magazine title of council trustee failure because they tried something and didn't get it right. So I would go for a risk appetite reset.
Better risk appetite, love it. Will increase your risk appetite. Sophie.
I would say don't forget the people. I think we're risking that at the moment. one of the examples that I was going to talk about was real estate. I think in the housing sector in particular, it's big for Lloyd's. The households are being burdened with the cost of the transition in a lot of ways at a time where there is a cost of living crisis, and this is losing public support for net zero. And if we lose public support for it, we won't get anywhere.
And finally, Julie.
And on my side, I say a little bit of everything, some positivity, dynamism. Fully agree with Stephen on the risk appetite, and I'd say the financial sector has a responsibility as well to innovate, to find new ways to channel financial flows. And I think to your point, the fact of having blended finance, public-private partnership to reduce the perceived level of risk is a way to channel more flows.
So you've heard it here first, people. Be more thoughtful and think outside the box, have better risk, think about people, and have a positive attitude. So there we go, that's what we need to help mobilise our transition. So would you please thank my lovely panellists today for